name is Brad Muniz, partner at Sobel & Company. I would like to welcome you to Sobel Insights. Sobel Insights is a weekly series to provide some brief information on various topics. Our goal is to keep these sessions to 15 minutes. At this time, we do not offer CPE for the sessions. If you do have an idea for a topic or a speaker, feel free to reach out to me. You'll see my information later on in the session. Today's topic, early investing. It's come to me, actually a client had brought this up to me where they said they'd really like to have some information to be able to provide that they would know and that they could provide to their younger adults. And I've worked with Alex Panas for years, a friend of him. I stopped being as much friends with him when he would beat me in racquetball. I was friendlier when I was winning, but anyway. And Alex and I shared mutual clients, and we've had a lot of great intellectual discussions on how to help the clients. And Alex is always trying to think of ways with that. So I couldn't think of anybody better to bring up and talk about this topic. Alex is a managing partner and wealth advisor with Synthesis Wealth in Morristown. And I want to welcome Alex to Sobel Insights. Welcome, Alex.
Thank you, Brad. Appreciate it.
Yep. So most college grads who start working, may not be thinking about what to do with long-term financial planning. What are some of the issues they should be considering now? I mean, we should never give the date during sessions. Sally Glick in my office always yells at me, but it is around graduation time. So what should they be considering now?
That's a great question. And I do have a lot of conversations with my clients' adult children now as they graduate college and start getting jobs. And when I have those conversations, initially I focus on 4 key things that they should be thinking about. Of course, kids at that age are not necessarily thinking about long-term planning, right? 30, 40 years down the road. They want to sort of enjoy the newfound income that they're starting to earn. But I do have them focus on a few things. So the first one, I think the most important one, is to make sure that they have some sort of long-term disability insurance in place. Now, most employers provide that as a benefit, but the devil is always in the details as to what that benefit looks like, whether there's a cost of living increase on it. God forbid something happened to them at a younger age. It's not going to do much 20, 30 years from now if there isn't a cost of living increase on it. Also understanding that the benefit that they would receive would be taxable if the company is paying for that benefit for them. They can always add a little bit of supplemental coverage if necessary that they pay for. That would be a tax-free benefit. Certainly young adults are not thinking about disability, right? When we're at that age, we all think we're very, impenetrable, but in fact, it does happen. And unfortunately, I have some situations with clients' kids who had maybe a motorcycle accident in one case, a skiing accident in another case, and these things do happen. The second one I have them focus on is starting to put money away now for retirement. And the beauty of doing that at a young age in their 20s is time. And they have so much time for that money to grow for them. The savings they put away in their 20s will end up growing to be the largest part of their retirement savings when they get there. And unfortunately, Brad, as you know, we live in a defined contribution retirement planning environment, right? Our parents or grandparents maybe had a pension, right? A defined benefit, which would tell you what you're going to have in retirement to live on, and including Social Security. Well, nowadays, it's all about how much you can contribute to a plan, which does very little to tell you what you're actually going to be able to receive an income off of that in retirement. And since our retirements are going to be more like 25, 30, 35 years, right? Upwards of a quarter of your life versus maybe our parents or grandparents where it was much shorter. Accumulating enough savings to be able to fund that kind of retirement is critical, and starting early is critical. So I always tell a minimum 10%, preferably 15% contribution to their 401k, but certainly enough to get the full matching contribution if the employer offers one. The third thing I talk about is about credit cards and credit card debt. And a lot of kids can succumb to that. I know at a lot of colleges, they offer all sorts of prizes and gadgets if you sign up for a credit card. And, sometimes we don't think about it when we use that credit card. Really, really important not to accumulate a balance that you cannot pay off each month. Credit card companies will charge anywhere from 15 to 26% interest, which if they accumulate a lot of credit card debt will be virtually impossible to pay that off. Now, they should have a good credit card, right? There's good rewards on those credit cards if you use them. And obviously it's great if there's an emergency, right? If you need to call a tow truck or something like that. And as long as they make those payments on time, they'll also start to be able to build up their credit and hopefully a good credit score. And then the fourth thing I talk about is if they're considering buying a home at some point, that they should start thinking about putting some money away toward ultimately toward down payment. And I'll talk a little bit about that process and down payment, getting a mortgage, buying the house, et cetera, et cetera.
So you mentioned retirement, and I hear that a lot, and I espouse that. When my daughter was 15 years old and had a job on the books, I said, why don't you put towards an IRA? And she's like, for what? I said, for retirement. She said, no offense, Dad, I'm 15. And at that time I was late 40s, early 50s, whatever it was, late 40s. And I said, well, no offense, but I never thought retirement would be so close. And, I said, it creeps up on you. I said, but think about it. If you start putting away now, how much it'll grow. And what I said to her at 15 years old, I said, whatever you put away, it wasn't going to be a lot. I said, I'll match it, just to have her thinking about putting away into an IRA or some sort of retirement plan. She took advantage of it. The other two didn't, which is good because they probably would have bankrupted me. But anyway,
well, that's great advice, and that's a great incentive for you to do that for her. So that's terrific. Gives her a good head start.
Thanks. So as it relates to retirement plans, though, and I get the question a lot, and it's like, I'd love to hear from a financial advisor, especially for the younger people. Where should they be putting their money? Pre-tax, after tax? What are your thoughts on it?
Yeah, that's a great question. Throughout most of our careers, Brad, yours and mine, right? We always thought about pre-tax contributions. Save as much tax as you can today, defer it till the future. You'll be in a lower tax bracket in retirement. I think some of those dynamics may be changing. Now, it's probably changing for those of us that are closer to retirement. The younger adults and kids, it's still kind of early for them to understand what tax environment will be like then. But with the fiscal irresponsibility of our government right now, it's likely that the government will have to raise tax rates on us in the future. But for the young adults, presumably they're in the lower brackets in the infancy of their career, right? They're starting out, they're getting this introductory salary. It may seem like great money to them right now, but it probably puts them in a lower tax bracket, in which case a pre-tax contribution doesn't really save them all that much tax money, right? If they're in the 12% bracket, it's not saving them a whole lot. So often I'll recommend that they put that toward a Roth 401k or 403b, depending on whether their employer's plan offers that. And if they have the wherewithal to save into a Roth IRA as well, up to $6,000 this year, they certainly should do that as well. Once their income starts to grow, maybe they get married, a spouse's income, their combined income is a little bit higher bracket, then they could always switch to a pre-tax and save at a little bit higher tax rate. But I think in the beginning, being able to accumulate some Roth assets is very important. Even if it's just for a few years and then they move into a higher bracket and they want to go pre-tax, the growth on that Roth IRA or Roth 401k money over the course of the next 35 to 40 years is going to be absolutely astronomical, and it's all going to be tax-free. And listen, if tax rates do have to go up dramatically to help fund our deficit and to help fund the interest on our national debt, then they will be able to live on tax-free money out of the Roth IRA.
Yeah, hopefully the government keeps it that way too. So, that's a great insight into that. And for putting aside the whole real estate market, because that's just, I don't understand it right now. I understand it, but the younger people, so a lot of them are coming out of college and they're starting to think more about investing. The one thing I did try and talk with my my children about when they were younger was about investments, and they didn't care. All of a sudden, my son's starting to trade stocks. My daughter's asking me about different investments. I'm like, where did this come from? I tried to talk with you about it, but it wasn't cool then. But it was refreshing to hear them talking about it. And I'm sure mine are different than other young adults. They're starting to think about investments. And I imagine part of the process is part of the reason is the hysteria, the hype that's going on. And what should we be telling the younger people when you look at TV and you hear what Bitcoin is doing, and they all want in on it? What are you trying to tell them?
Yeah, it's a challenge, right? Because there is a lot of media, there is a lot of hype about a lot of technology companies that are doing phenomenally well, and tremendous returns in a short period of time. Bitcoin that has appreciated 1,000% over the last couple of years. But we also see a lot of the volatility with those type of things. The reality is, back in the early 2000s, when you had the infancy of companies like Microsoft and Amazon, there were thousands of companies like that, right? And it's so incredibly challenging to be able to identify the companies that are going to succeed and do well. And it's not simply a function of the company having a good product or service that you think is really going to last, right? There's lots of examples like Blockbuster, right, where it was just the technology changed and made that company somewhat obsolete, or companies like MySpace, things like that. So it's really, really challenging to try to identify that next Amazon, that next Google, that next Microsoft. And there's thousands of losers out there for every Microsoft, right? That's a big success story. So I try to challenge them to think about investing in a much more diversified way. And one of the very easy and convenient ways to do that is utilizing some type of investment company product. What I mean by that is a mutual fund or an exchange traded fund, something that's regulated under the Investment Company Act of 1940, right? Whereby they can get diversification. Maybe they get professional management through a mutual fund and have a greater chance of success, allowing that mutual fund or ETF to effectively invest their money for them. The exchange traded funds typically will track an index, and there's a lot of different exchange traded funds out there. So if they do have a little bit more of a proclivity toward owning or investing in technology, they can invest in a technology type of mutual fund or exchange traded fund and still get that great potential growth in that sector and industry, as long as they understand there'll be a lot of volatility. They're going to see negative returns. We're experiencing sort of a correction or sell-off in growth in technology stocks right now, as we start to see this transition of investments going from those companies that did very well during the pandemic and quarantine, and now shifting toward investing in companies that had been beaten down last year, but are anticipated to start doing well, right? So we're seeing kind of that rotation. And that's okay. Technology is not going away. Those companies are not going away, and they're going to continue to do well, but they just happen to be out of favor right now. So they've got to be disciplined. They've got to be diversified, and they have to be able to accept the fact that over time, those returns will be 8 to 10%. You're not going to necessarily be able to sustainably get a 50% increase because you bought some Bitcoin or you bought some shares of a single company. One of the problems with investing in a single company or a very small number of companies is you have additional risks, can potentially lose your money for things that don't affect the industry or don't affect the market. And again, we've got dozens and dozens of examples, Enron from the early 2000s and Blockbuster, as streaming became more prevalent, and even things like Martha Stewart, right? She's a great example of a stock that just got hammered when she was indicted for insider trading. Now, she just made a bonehead move in her personal investments, in her personal life, but that affected her company dramatically, right? So that's not a technology company, but a great example of something that can happen to a company that doesn't necessarily happen to the whole industry or the whole
Right.
market.
Great. So they've got to stop worrying about the big bang. I'm sure it's going to be there. If they can find it, good for them. But long term is really what they should be focusing on.
Well, and oftentimes I'll joke around and say, listen, if you really want to gamble like that, go down to Atlantic City, because at least you get a free show and maybe a free dinner out of it as well.
And a drink, right? Well, those are the questions I have. I appreciate you taking the time. Remember, everybody, I appreciate you for listening in. If you have any questions, feel free to reach out to us. Reach out to Alex. Those information will be available on the presentation also. And I want to thank everybody for attending. Alex, thank you very much for giving us.
You're welcome, Brad. Good to see you again.
You too.